The willingness of Netflix to sacrifice current income. I think as value investing has evolved, more of the interesting opportunities today are coming from these businesses that the PE ratio does a really poor job of assigning value.
So you purchased the stock at $200.
I did.
What is the message you're trying to send here?
Well, things change over time. The stock that we're talking about is Netflix. And one of our analysts presented it about 7 years ago. And his story was basically, everybody's focused on the wrong numbers here. What you should look at is the market thinks HBO subscribers are worth whatever the number was, I don't remember, $800 a sub. And Netflix subs are worth a small fraction of that in the market. And it seems like that's wrong. Netflix is growing so rapidly, HBO isn't. So at the time, we knew a lot of people in the media industry because of investments that we had, and we talked to them, and they said, Netflix is hugely risky. HBO spends about 3 times as much on programming as Netflix does. They could basically squash it anytime they want to. And he said, by the way, look at their churn statistics, especially in the month of February when they release House of Cards. This is a one-show company. Most of the media companies that have sold programming to them regret the decision. They had no idea it would be sold to so many people. So they're going to see enormous increases in programming costs. When House of Cards goes up for rebid, they'll easily be outbid by one of the bigger studios. And we looked at it and said, the stock's cheap, but it's really at a very risky stage of its lifetime. And one of the things we do at Oakmark is if we think the risk and reward have to be in balance to make something interesting. You can't go into a high-risk situation for a small reward. You'd only want to be in a high-risk situation if the reward is very, very large. And as we looked at it, the risks were just too high. So I was saying earlier, I don't even think of this as a mistake. And I think you learn a lot about investors by what they look back on and say were big mistakes. A lot of people would say, this stock went up 10-fold, 20-fold maybe. Not buying it was a big mistake. Well, it didn't meet our criteria. When we researched it thoroughly, it didn't have the risk-return profile that we were looking for. And fast forward to just a few months ago, one of our young analysts comes into a large room. There are about 20 of us in the investment team that sit around the table. He'd written a report on why we should buy Netflix. And I'd gone through it. And of course, it's hard to get out of your mind that you missed buying it at like 5 or 10% of the current price. And the report didn't really jump out at me. We go into the room and he starts by saying, people subscribe to HBO Now and they pay $15 a month. They subscribe to Spotify, they pay $15 a month. Sirius XM, more like $20 a month. Those same people, when they rate the services they subscribe to, say Netflix is more valuable to them. He said, if Netflix, instead of charging $10 a month, charged $15, it would be selling at 13 times earnings. And it was like the bell went off. It's like, that's a way of thinking about the business value there that I had never thought of. That the willingness of Netflix to sacrifice current income by not charging as much as they could for their product, to instead grow their subscriber base 25% a year, get to the point today where the moat has become almost so large that it's impossible to think of somebody displacing them. $8 billion a year on programming. That's almost now 2 to 3 times what HBO spends on programming. And because the sub base is growing so rapidly, the cost per subscriber is going to be substantially less for any programming that Netflix considers buying compared to HBO. Now, clearly that's a stock most value managers won't touch. It sells at almost 200 times earnings. The market's at 18 times earnings. It's just a name they don't even think about. But I think as value investing has evolved, more of the interesting opportunities today are coming from these businesses that the PE ratio does a really poor job of assigning value. We talked about companies that have non-earning assets, and I was asked not to talk about this company, so I won't. But there are companies that have a lot of cash on their balance sheet that earns almost nothing today. So the PE investor really is getting cash for free. There are companies that are investing in unrelated businesses. It's costing them current income. You get in kind of this weird area where most value investors won't buy it because the PE ratio is too high. Sometimes growth investors aren't excited about them anymore because they aren't in that upper decile of growth rates. So I think of it as kind of an overlapping area between growth and value, where the growth rates are higher than value investors are used to, the prices are cheaper than growth investors are used to, and the names kind of fall through the cracks there. And you find a lot of our portfolio at Oakmark has large pieces of hidden value in assets that aren't currently earning anything.
I'm just wondering about Netflix's moat in general, independent of their valuation. Could there be danger to Netflix from other people who could come in and compete with them on as big a scale as Netflix has?